And good afternoon, everyone. My name is Randy Price. We are the Price Group. I trust everyone had a good, if you can say good, tax day, April the 18th. But today we're not talking about taxes, we're talking about something equally as complex and a little bit bewildering, and that's fixed income. So the title of our webinar, our talk today, is an update on fixed income. Today is April the 19th. This is being recorded, and we thank you for taking time to be with us. Who are we? We're a family-owned and operated boutique, if you will, within Stewart Partners. 45 plus years of experience between Matt Price and myself. We are a fiduciary, and our clientele are people that are retired or approaching retirement. As a part of that, we need to delve into the weeds and understand fixed income. So whole purpose of the talk today is to give you an update, to talk about what we think would be helpful for each of you as fixed income investors.
So a little bit more about us. Randy's too humble, so I'll brag on his behalf. Just here in the past few weeks, he received the 2022 Forbes Award, which we're really proud of. Been mentioned by Barron's and Financial Times in the past as well. We've worked hard on sending out a lot of email communication over the past few months, and we're looking to actually increase our video content here sometime this summer. So keep an eye out for that. We think education is really important. Randy and I both certified financial planners, and then we also have our CIMA, our Certified Investment Management Analyst designation on top of that. So look at the agenda, what we're going to be talking about, a look back at history on how bonds performed, inflation, we like to call it the hidden tax, talk a little bit about the Federal Reserve's interest rate policy, what's happened thus far, and what is expected here for the rest of the year. Municipal bonds in particular, we'll make sure to talk about. Is the bond market signaling a recession? That's a good question, and there's been a lot written about that over the years. We'll look at it from a few different angles to hopefully fully answer that question. What opportunities are there moving forward, and then where can we go from here? So with that being said, let's take a look back at history. Here's a look at the history of bond returns dating back to 1940. And as you can see, a majority of the years are green. There's actually only 10 years, not including 2022, that the overall bond market has had negative returns. So historically speaking, positive returns, you can see this black line where interest rates. So even in a rising interest rate environment, there have been quite a few years with positive returns. Where do you go besides stocks? We think that bonds still make a whole lot of sense in a retiree's portfolio. Just historically, they have been the ballast to the ship. They have been able to zig when stocks have zagged. So far in 2022, that has not been the case with stocks and bonds both down. But historically, long term, we do think bonds still make sense. That's one of the things we'll talk about in more detail, even if interest rates are moving higher.
Still talking about history here. We're going to talk about historic moves in the bond market. Unfortunately, you made some history since you were by definition alive in the first quarter of this year. First quarter of 2022 was the biggest drawdown since the 80s. And as you may remember, interest rates in the 80s got to a very high level. Money markets up in the 20% range, the 10-year treasury at about 15% or whatever. So again, bond moves as measured by the Barclays Aggregate Bond Index, the AG as it's affectionately called. And you can see there some of the years we've had some big drawdowns. And again, fortunately or unfortunately, depending on where you are, the first quarter was a big drawdown as interest rates, both short-term as well as long-term, went higher. Probably the easiest way to think about this is, mortgage rates for a 30-year mortgage are now over 5%. So we talk about when things go down, we talk about when things go higher, again, thinking from a historical perspective, but here are rebounds, quarters with bonds down greater than 3%. Obviously, we punched that that ticket, and you look back there on the left, the Q2 of '84, the Q2 of '87, et cetera, and you look at what has happened following a rise in interest rates where the bond market got beat up. History does not repeat itself automatically, but often it rhymes. And so we get the average and the median rates, if you will, but typically large drawdowns are followed with a positive quarter in both stocks and bonds. Again, historically speaking, looking at just the facts from a historical perspective.
So interest rates are likely to rise, we think, from here, but only modestly. The two busy charts here, and we're going to have a few busy charts. Randy and I will do our best to maybe add some color to them in the next 20, 30 minutes or so. I want to draw your attention to this chart on the right. The 10-year yields tend to rise when tightening begins. What is tightening? Tightening is when the Federal Reserve, sometimes known as the Fed, will increase the short-term interest rates. So when we say short-term interest rates, think cash at your bank, money markets, short-term CDs, any type of short-term fixed income investment that is very liquid. Left of the y-axis here, to bring you back to your high school math class, is before the Federal Reserve increased interest rates. And then here to the right is after the Federal Reserve stopped increasing interest rates. And this is a look back at history on average. What this chart tells us is a lot of the interest rate movement actually happens prior to and in the first few months after the Federal Reserve increased interest rates. So why is that? The bond market as well as the stock market, it's a little bit of a forward-looking entity. And so the bond market is essentially guessing or making a declaration on what it thinks is going to happen into the future. Hence why a lot of the interest rate movements happen on the front end of that. So with that being said, we think the interest rates, we've seen a lot of the movement we're going to see this year. It would not surprise us if the 10-year U.S. government bond, which is really the barometer for interest rates here in the U.S., moves above 3%, but we think it settles back below 3% toward the end of this year. So what are the forces keeping the 10-year U.S. government bond below that 3% number? Draw your attention here to the middle chart. Pension funds and bond allocations are on the rise. The average pension fund across the country has round numbers about 40% non-stock investments or bonds in their portfolio. And what is expected to happen here over the next 3, maybe 6 months is you're going to see a lot of these pensions rebalance into bonds, given the fact that bond prices are down, given the fact that bonds are now yielding more than they were at the beginning of the year. So we think that's a catalyst to keep interest rates a little more muted. And then not to mention the chart here on the right, foreign demand remains elevated. Interest rates on a relative basis, so comparing the US to other countries across the globe, still has high interest rates. So there are, whether they're individual investors, institutions across the globe that do find the US bonds higher and more attractive than their current bonds in their own currency. I like to say America right now, from an interest rate perspective, is the cleanest shirt in the dirty laundry. So yields are not high, but on a relative basis, they are higher than others. Randy, you want to take this next one?
Yeah, okay, so a year of repricing. What's happened in a short period of time, Treasury yields have risen very rapidly. In fact, as the chart on the left shows, the swiftest repricing of the 2-year Treasury in history. And think about that. Many people think the Federal Reserve got behind the curve, as they would call it, and the Federal Reserve has been known to be either loose money, sort of normal money, or tightening. And we haven't even really gotten back to normal. And so even at the Federal Reserve meeting that's coming up, there's an expected expected rate increase of 0.5%. That's caused, as we sort of touched on, an accelerated increase in the 10-year Treasury yield. And so everybody's question, everybody's wonderment is, where do rates go from here? Again, where is inflation? That's one thing that we'll take into it. What will Federal Reserve, what will tax policy do? Another interesting fact is typically as you enter a year of political elections, supposedly the Federal Reserve is supposed to remain neutral. But again, the Fed, we think, feels like they're a little bit behind in trying to get back to just a normal position. But if you look at our fixed income allocation, or the allocations that we recommend, obviously when interest rates are going up, the shorter, what we call duration, short-term bonds go down less in value when interest rates go higher than long-term bonds. So again, when we talk about the 2-year Treasury, the 10-year Treasury, there's a big difference in that, and we'll get a little bit more detail of that as we go forward. So what is inflation? Inflation is the hidden tax, a little bit of a rule of thumb. Take the rate of inflation and divide it into 72, and it tells you how long it will take prices to double. So if you have 2% inflation, you're not really worried about it, right? 2 into 72 is 36. So every 36 years, you get a doubling in prices. Price of a movie, the price of a gallon of gas, the price of a used car, the price of a vacation, etc. You get up to a 12% rate of inflation, voila, and inflation has been at 12% again historically. We don't think it's going to get there, but again, just to illustrate my point, 12 into 72 for you math majors is 6 times, so you could get a doubling of the cost of living every 6 years. And it's that hyperinflation, it's that unexpected inflation that really strikes at the heart of the consumer. And as we talk about here, many of consumers have gotten raises. Your after-tax earnings are greater, but then you have gasoline prices. A year ago, oil was $50-ish a barrel. Now it's over $100 a barrel, and so gasoline prices are up. And what does that do? Grocery prices, because everything runs on energy, real estate, the price to build, and so many people today, what they find is, after even an increase in their income, they're paying more taxes and they have less to spend on an after-tax basis. So again, a hidden tax, something that has to be balanced in the Federal Reserve policy as they seek to do the best thing for the country.
One thing to add to that, the good news is consumers as a whole entered 2022 in a really good shape, financially speaking. So this obviously is a deterrent from that, but started out the year in really good shape. Let's look at the different components of inflation. And you talk to 6 different people, or you read 6 different articles, and typically there are 6 different ways that you can put together an inflation number. But here are the major components of how inflation is currently being put together. It's worth noting here, the red in this bar chart, new and used vehicles, makes up almost 20% of the overall total of inflation. So there's whispers that a lot of these chip shortages, the carnage is not done, but they're finding different ways to get these chips to where they need to go to put them in the cars. Read an article that there's each large car manufacturer has hundreds, if not thousands, of cars ready to cross the finish line of production, but they're waiting on 1, 2, maybe 3 chips just to get that done. So hopefully a lot of that proves to be transient. The other pieces we don't think will be transient. Higher energy prices are probably here to stay. Higher food prices are here to stay. Higher shelter prices are probably here to stay if you are a renter. So We think the good news there is hopefully some of the new and used vehicle portion of the inflation could start to roll over at some point. So rising food, rising energy prices, you can see here, you don't need charts for us to tell you that eggs at the grocery store are more expensive. But what we think is important in this type of environment is we're looking for companies that not only that have a propensity to pay dividends, but can increase those dividends. And most of the time, those are the type of companies that can pass through a lot of this inflationary cost of doing business, whether it's wages, the actual cost of the commodity to the consumer. And so we think moving forward, focusing on companies that can pass through their inflation costs to the consumer are the companies we want to focus on. Like I said, a lot of those companies are the dividend aristocrat companies. And not to talk politics here on a cloudy Tuesday afternoon, but inflation remains the Achilles heel for the current president, the White House, Congress, Senate, everyone. From a standpoint, this is a real hot topic, pun intended, for voters, with it being an election year later on this November. So the Federal Reserve, as well as the White House, probably have a real agreement on they want to mute inflation here in the next 6 to 8 months, just for elections coming up later this fall.
Okay, inflation is a depressing subject. Let's talk about the Federal Reserve's interest rate policy as we get into dive in a little bit with regards to what's going on. What are the Fed's expectations? Again, we talked about being passive, being neutral, and being aggressive. This is looking at the expectations of a half point increase at the next Federal Reserve meeting, which will happen there the 1st of May. The Fed is in a constant balancing act. Think about that. If you have low interest rates, that helps companies make more money, helps people borrow more money. Borrowing more money can help sell more cars, sell more houses, etc. But on the other hand, you cut against the savers. When you have low interest rates, people that are living off their savings can't make as much interest. And so there are times when the Federal Reserve will lower rates. There's times when the Federal Reserve will raise rates. Again, a balancing act by our nation's bank, the Federal Reserve. I was talking to one person, and I liked their analogy. They said inflation is sort of like a wild dog. Once it gets off its leash, it's hard to get back on. If you were to ask us, Matt, Randy, how many interest rate increases is the Federal Reserve going to do or going to make? People have been all over the board, all the so-called experts with regards to that. It's almost a foregone conclusion, or very accepted, being priced into the marketplace, that the Federal Reserve will go up 50 basis points, or 0.5% at the May meeting, where they go from there. They're trying to get back to somewhat the neutral. Aggressive would be, again, could slow the economy down at a time where you have higher prices, higher inflation, this sort of thing. So chart on the right shows the trend of Fed funds and the Fed funds forecast on there. And so, again, stay tuned. No one really knows. People make a living of clicks and people on the TV channel by trying to predict exactly what the Fed is doing. What we've learned is that this is a somewhat of a loser's game, trying to pick like who's going to win the March Madness. On there, we know rates are going up. We know the Fed has to get more involved. We just don't know exactly how much. And but again, stay tuned as we go here. A little bit of a busy slide here, but this is a history of Federal Reserve rate hikes since 1994. The market is always looking forward. Again, a bit of a busy slide, but the red line is the anticipated interest rate increases from the Federal Reserve. That's a very aggressive stance. Put Mr. Powell's name right there, and you look back in history and see some of the other Federal Reserve chairmen based on that. So again, people have measured this since the beginning of time. There's always people that are very adamant that they know exactly, or predictions. Sometimes they're right, sometimes they're wrong. But again, we've been in a long period where interest rates have been near zero. Nobody, I don't think, is surprised to see rates going higher. And again, when rates go higher, it means the economy is picking up, and the Federal Reserve doesn't want too much inflation. So you can make a good case that the Federal Reserve raising rates or rates going higher is a really good sign for the strength of the economy. Frequently asked questions for our beloved friends at the Federal Reserve. Short-term interest rates, those would be overnight lending rates. You see that show up in money market rates, so on and so forth. The medium, the long-term interest rates, typically the 10-year Treasury is sort of what is quoted. The 10-year Treasury is getting near 3%. That's the if you will, medium/long-term interest rates that most mortgages are based on. And those longer-term interest rates operate on supply, demand, prospects for future inflation, this sort of thing. Soft landing for the Fed, that's sort of their ultimate goal. Raise rates, get things under control, but not be too aggressive with the rates that might jolt economic expansion and economic activity lower. Think about that. When they raise rates, that helps the people that are savers. But if you're a credit card owner, credit card person has a credit card that carries a balance, your interest rates go higher. If you're borrowing money for a car, typically your rates go higher. If you're borrowing money for a loan, typically, again, your interest rates go higher and your costs get greater. And if you're a corporation borrowing money. So it's sort of a regulating function. The Federal Reserve is, again, trying to achieve a balancing act of keeping keeping slow growth and steady growth, looking at employment, but not letting the hidden tax inflation get the upper hand and lead to some carnage in the financial markets as well as the consumer. Will my cash start yielding more? Yes, at some point, but it's probably going to take at least one or two more interest rate increases before you see some of the money markets really pick up. These money markets haven't made money, actually been operating at a loss for a while, and we'll see what happens. But you will, again, see some relief if you are investing in short-term interest rates in the near future.
So let's talk a little bit about the municipal bond market. Have a number of clients on the call that are municipal bond investors. The municipal bonds, we think as a whole, are in a real healthy spot, financially speaking. You can see here last year, the national average revenue increases for these municipalities was up about 19% across the country. And most of the municipalities are financially healthy. You might not have noticed it, but for those in Harris County, the percentage that you paid on your property tax actually went lower. Now, the tax bill probably went up, but the percentage based off the assessed value of your home slightly went lower for Harris County residents. With that being said, it's been a hard year to start out with as a municipal bond investor. We positioned the portfolio to be a little more sensitive to credit. What that means is instead of taking interest rate risk, we own some lower quality credit bonds. Historically speaking, that's worked out well from a standpoint. The lower quality credit bonds, assuming the credit is good meaning it's not defaulting, they have less interest rate sensitivity. We think so far this year the baby's kind of been thrown out with the bathwater from a standpoint. Credit bonds, interest rate sensitive bonds have all moved lower. And more specifically, the municipal bonds have been hit harder than the taxable bonds. And a big reason for that is, as you can see on the slide, over 2/3 of the overall municipal bond market are owned by retail investors. So retail investors would be mom and pop, your neighbor, anything like that, opposed to the taxable bonds. They're a lot more institutional type owners, pension funds, endowments, etc. So at times the municipal bond market will overreact in such a way that makes the taxable market look a little more tame. We actually think this is a great opportunity to be adding cash to the municipal market. We haven't said that since the spring of 2020. For those of you that were clients in 2020 or followed along with our emails, we wrote about how we were seeing bonds being priced at crazy levels back then. We're starting to see some of that now. We're starting to purchase more individual bonds for clients where the yields are getting up to where it is once again interesting to do that. But a majority of tax-free bond owners or municipal bond owners are not necessarily that interested in the price movement up or down. They're more so interested in the income generation and the tax sheltering, the tax-free income that these bonds produce. So the good news there is the income moving forward is moving higher. And bring you back to your childhood playground, it's like a seesaw. When the interest rates go up, the bond prices go down. But when the rates go up, you're going to be producing more income in the future. So a little bit of a rocky road to get there. We still are very comfortable with tax-free bonds. We're starting to add to some tax-free bonds here as we speak. Also, looking back at history, time heals the muni market. A little bit of a busy slide. The slide here on the left, there are negative returns 28% of the time for municipal bonds when you look at it on a monthly basis. But if you look at it on a rolling 2-year basis, historically speaking, there have been negative returns 0% of the time. What does that mean? That means that bonds will sell off, they'll come back, and this is not something new in the tax-free bond market. I'm reminded of the 60-minute episode. It's been a number of years now with Meredith Whitney, where she went on to 60 Minutes and said there's going to be blood in the streets. These municipalities are going to all default, and the world as we know it is going to cease to exist because these municipalities are all going to default on their debt. And that Monday, the very next day, we came into the office and the municipal bond market started a week, maybe 2-week long sell-off at a really quick pace because of her comments. And what we saw in the following few months is Meredith Whitney ended up being wrong. There was not widespread carnage within the municipalities, and the bonds did recover. So I'd say a majority of our clients do own municipal bonds for income. And with that being said, we're still very comfortable with the overall credit quality of municipalities, and more specifically what we currently own for clients in their portfolios.
Right, I wonder where Meredith Whitney is these days, if she's still in the business. So anyway, so key question, is the bond market signaling a recession? Let's go over what a recession is. You know, there are mild recessions and there are deep recessions. Recession by definition is 2 straight quarters, measurement over a 3-month period, where the economy does not grow. Now, the press can talk this up and talk about how harmful a recession is. The economy will obviously ebb and flow. It's not the mild recessions. In fact, most people, if they didn't look at the statistics, probably wouldn't know the difference between a mild recession and a mild economic expansion. But it's those deep recessions that are troublesome and cause recessions that you remember. So we talk about what's called an inverted yield curve. Let's explain that. When short-term rates are higher than long-term rates, this is called an inverted yield curve. Typically, short-term rates are lower, long-term rates are higher, and you get a positive upward sloping, if you will, line or curve. And so again, when short-term rates are higher, and you've got the listing there on the left of the dates that happened, when a recession happened, months from inversion to recession, And what you see there, even if that's happening, it was a number of months from that event happening. We're not predicting this is going to happen, but again, giving you a look back on history, often rhymes. And then some people will say, I need to get out of stocks, or stocks scare me. We may have a recession. Well, if you take the 500 largest stocks and look at their cumulative return from the inversion to the recession, wow, look at all those positive numbers, an average of about 20%. So don't get caught up when some of the financial press wants to press the panic button and get more eyeballs or more clicks from that. But we'll keep you posted as far as what's happening with this crazy interest rate environment, if you will. But an inverted yield curve is not the end of the world. The next slide here.
And one thing to add to that, we'll be sending out our quarterly recession dashboard here in the next few weeks. And the inverted yield curve is one of the 12 indicators that we use to try to help us make an educated decision on if we think a recession is around the corner, but it is only one of the 12 indicators.
Good point, Matt. And again, our goal is to keep you updated on a lot of this information. If you're not subscribed to get our emails, clients as well as people that are not clients tell us they're very helpful to keep them updated on some objective information. So recession probabilities, recession probability as given to us by the yield curve. We go back to 1920 here, and there's different kinds of yield curve, if you will, the 30-year versus the 1 year, the 30-year versus the 3-month, the 30-year versus the three-month, etc. And so you can see there what has happened during that period of time, the percentage of time a recession happened in the 2 years following inversion, number of inverted trading days reading as the close of March 25th. A lot of different type of inversions. Not much is inverted right now. So you can see that we've got there on the red right-hand side, you've got only 2. So again, a little bit ahead of ourselves, but again, just covering this information to give you clarity, comfort, and confidence that this is all part of our investment process. We think it's very critical for a fixed income investor to have a process. Most people, or a lot of more people, have a stock investment process than they do a bond investment process. And so again, if we're going to enter a period where rates are rising, a period where things are changing, the flip side of stock market investing, which would be the ballast of the portfolio, the fixed income, the bonds, tax-free, taxable, etc., become even more important. And that's what we're wanting to communicate here, is that we've got you covered on that. So enough talking about fixed income. Let's talk about stocks. Let's talk about equities. Equities have generally outperformed following the most recent yield curve inversion. The period here from 2019, August of 19 to the end of the year, return from the inversion date to year end, and then the period for the whole year of 2019 during the calendar year the inversion occurred. So here's 2 recent examples of relevant data that are very close in the rearview mirror when equities did very well. Stocks tend to perform well for months before an inversion occurs. And then we've got people that have different varying percentages of stock, but when we compare stock dividends to bonds, you can see there the 10-year U.S. Treasury yield in the blue and the S&P 500 dividend yield. Yields are still historically low, and one of the interesting sort of pieces of information out there, if you go back to the economy in 2018, and I realize that seems so far in history, that was pre-COVID, et cetera, but the economy in 2018 could handle this level of interest rates. Why can't the economy handle these interest rates today? We are still big proponents, still big believers of dividend stocks. We think a dividend stock is a great multi-generational planning tool. We think a dividend stock, if done correctly, not only gives you a nice yield, but an increasing yield, a yield to mitigate the effects of inflation. So especially at a time period where we feel like the market is not going to be in double-digit gains going forward. By the way, we hope we're really wrong about that, but we call that reversion to the mean. And if you do get 7, 8, 9% in the stock market as a whole, and you can get a bigger proportion of that from dividend yields, we think you're far safer, far in better shape. And again, if that's an increasing dividend yield, so much the better. So again, one of our secret sauces, we think, is using dividend stocks, getting income for retirement, for your retirement portfolio there.
So let's look at what opportunities do we think there are given what's going on in the overall bond market. We think one of the biggest opportunities is in credit. And just to review, when we say credit, we're talking about the lower quality bonds. So for example, maybe a double or triple B rated bond opposed to a double or triple A rated bond. And historically speaking, if the credit is healthy, if the company is healthy, these companies are going to be less interest rate sensitive. And that hasn't been the case so far this year. Overall, and this would be one of the main things Randy and I want everyone to take with us, we entered 2022 exactly the way we wanted to with our taxable fixed income strategy. We were heavier on credit, less interest rate sensitive. We were shorter in duration, less interest rate sensitive. And our largest holding was our floating rate bonds. Floating rate bonds can increase their income as interest rates move higher. So we positioned, we think, well, we were a little early to the game. We actually started this positioning a few years ago and slowly worked our way into it. But we would think that moving forward, there could be an opportunity if and when interest rates level off, that these credit bonds pop back a little bit quicker than the higher quality bonds. Once again, talking about taxable bonds, just because these companies are not historically as interest rate sensitive. So that's where we think the opportunity is moving forward on the taxable side. On the tax-free side, we already mentioned, we think municipalities overall are in good, healthy financial shape. And we think there's really a lot of opportunity now on adding cash to some of the municipal bonds at higher yields with good credit behind it. So we're going to continue to look for some individual bonds to complement what we're already doing. But we think the municipal bond market as a whole is becoming more and more attractive. And already mentioned this, but floating rate bonds, lower credit for some accredited investors. We've already spoken about some fixed income alternatives here over the past few weeks. Preferred stocks are like the first cousin of bonds. Historically, they're less interest rate sensitive as well. And then real estate. So we look at it as a recipe effect. You come over to our house, my wife is making chocolate chip cookies. If you look at all the ingredients separately, it doesn't look that appealing. But when she puts them together, puts them in the oven, they come out of the oven smelling good, you know they're going to taste good. And we think the same thing holds true with a fixed income process. Randy mentioned earlier that a lot of people have a stock investment process. We think it's probably been a harsh reminder over the past quarter. Having a fixed income process is equally, if not more important, when interest rates are moving higher. So we are big, did I say big, believers in having a fixed income process here over the next couple of years.
Some of our most often asked questions: does it make sense to hold fixed income or bonds if they are losing money? How we wish we were smart enough to jump out of bonds and then jump back in. Obviously, that's market timing is an impossibility. Again, to reiterate, bonds are the ballast of the portfolio. We want everything in the portfolio to produce money. On the stock side, our stocks are producing dividends for us. And on the fixed income side, again, it's not a game of perfect. It's a game of having ballast and rebalancing, having an investment process, having a reason to do something, or more importantly, sometimes a reason for doing nothing. Looking at the information, Matt talked about specifically municipals. Looking back, it's and one of the big mutual fund companies has a study on this, but the average individual investor has based their investment decisions on emotion and have underperformed the long-term averages, whereas the institutional money is more logical. And we think that typically the individual investor is many times wrong. We'll see how this works out going forward. But again, having an investment process, as Matt pointed out, we think holding some fixed income is indeed, especially if you've got some floating rate bonds and some things that are more agnostic to rising rates, we think that is a good part of a diversified portfolio. Well, interest rates keep rising. Yes, again, we think the worst is over. And again, you've seen some real discrepancy between taxable and tax-free. And there's ways to mitigate and to perhaps lock in some of these higher yields depending on where you are. How high do interest rates go? We're not of the thought process that we get into double-digit interest rates, double-digit short-term or long-term. You look at statistically the move in the mortgage market. We had a client lock in a 2.5% mortgage. That same mortgage would be over 5%. So you say, you know, interest rates have doubled. Matt talked about the international appetite for U.S. government bonds, and if you like the U.S. Treasury at 1.5%, you're going to love it at 3%. So we think rates go higher. It's an impossible question to ask, but it's something that we look at on each and every day, and it's part of our investment process as our investment committee meets and talks through all of these potentialities. Good question there. Matt, any other questions as we move toward the end? I'm happy to report the trains are running on time.
Yeah, no questions yet, but send us an email, give us a call. We're obviously available and happy to dive into this in more detail if and when needed.
So again, that's Maddie Kearns, Tiffany Solis, myself, Matt Price, Melissa Hamner. That we are the Price Group. And again, our goal is to be a source of information, a source of objective feedback, a second opinion, if you will. Our secret sauce is planning. We spend a lot of time with folks prior to retirement to give them comfort, clarity, and confidence, preparing what we call a live well plan. We're a little bit corny in that we want all of our clients to live well. And if we do that, the clarity that we do in our planning process, which most people don't want to devote the time or the effort because it is messy and does take a number of hours of study and preparation, then the clarity will lead to confidence. The confidence you have will lead to comfort. And that's the end result that everybody is looking for in their retirement planning. So we think everyone needs a wealth coach. That's our goal. That's what gets us up in the morning. And we'd be honored to have you on our email list, to talk to you if we could give you a second opinion or help you with your retirement planning. Again, reach out to us. Email addresses, telephone number there. And with that, we'll say have a great rest of the Tuesday afternoon. Thank you again for joining us. And we sincerely hope to have a conversation with you in the near future. Take care.